Good morning, traders. My name is Christopher Vecchio, currency strategist with Daily FX. Today is Tuesday, May 5th, 2015. These are your FX headlines as we turn the page to North America, and it's going to be a pretty quiet trading session in the United States. The one thing I would keep an eye on would be the 10 a.m. Eastern release of the April ISM Services Index. Service jobs comprise about two-thirds of all employment in the United States currently, so taking a look at how that particular sector of the job market is performing will be fairly important as it pertains to the recent developments in consumption and how that might impact NFPs for this coming Friday. Beyond that, though, U.S. Data is fairly light. There's also trade balance figure at 8:30 Eastern, 12:30 GMT. That doesn't really affect the market, but maybe investors are looking towards that after what was a particularly weak first quarter growth print, and we saw that exports declined by 13.3% year over year, from a slight 2.4% gain in the fourth quarter. All right. When we're looking around the market today, though, we're seeing this U.S. dollar strength has more or less consolidated the past few days. Maybe it's because of expectations after the U.S. GDP report. Maybe it's because of prospective hope after FOMC and ahead of NFPs. But the picture couldn't be more clear right now. We're sitting at a major former support region in the U.S. dollar index. Coincidentally, also a resistance region from January and February where resistance had formed in the consolidation. And right now, I think the focus needs to be on whether or not the U.S. dollar can kind of get its swagger back after what was a very disappointing end to the month of April. Now, on a seasonal basis, during the QE era, April has actually been the worst month of the year. And so seeing that the U.S. dollar's underperformance after a stretch of weak data and oversized positioning, it really shouldn't come as a surprise to anyone. The caveat for May, however, is that due to this stretch positioning and the weak data, will the U.S. dollar run counter to its seasonal expectation? Because May has actually been the strongest month of the year. So, for lack of better phrasing, there's always been April showers during the QE era, but it's brought blossoming to the greenback and its pears during the month of May. And I know that sounds corny, but really that's the truth of it. And so the NFP print on Friday is thus magnified, because if it does get back on track, you have all this reason for hope now going forward that consumption will rebound with higher savings rate and low debt levels coming out of the first quarter, and that the Fed could raise rates going into the second half of the year. Addressing that concern, as we get out into this NFP print, you're going to hear media talk about the possibility that Fed raises rates in June. If the Fed is actually considering raising rates in June, then the market is really far behind, because right now, ever since mid-March, the market has dismissed the notion that the Fed was going to raise rates in June or even September, as of, I want to say, 2 or 3 days after the FOMC meeting in March. So we're talking about March 19th, 20th. The market, as implied by the Fed Funds Futures contract, has been pricing in a December 2015 or a January 2016 rate hike. So if a September or June rate hike is legitimately on the table for the Fed, the market has a great deal of interest rates to price back into the U.S. dollar. That could push up the short-term interest rate differentials. They say the 2-year note yield would rise in the United States, and concurrently the dollar would have a pretty big tailwind at its back to propel more strength going forward. So, even though we've seen and we're going to see a number of important data releases over the next few days, it really culminates with NFPs, and it truly is, the straw that could break or make the camel's back. And right now with NFPs, it's been the one major pillar of U.S. economic positivity that's been driving the greenback. Last month we had that bad print, of course. If you now have a second consecutive month of weak jobs data, you have to more or less embrace this idea that the data that we saw in the first quarter wasn't necessarily transitory. But if we do see a strong print, then everyone can say, see, the data that in the first quarter was transitory. It was the weather, it was the West Coast port strikes and shutdowns. Nothing to be concerned about. The economy is going to rebound in the second quarter now that jobs growth is picking back up. So with respect to some of these broader pairs, euro dollar at a very interesting level in here, considering that we've come right back up to the former highs from post FOMC. Also the daily 8 EMA, came right after a touch of the former range support low. So right now, ultimately, this hold that we have here of the daily 8 EMA and former highs, 110.50 to 110.65. If this holds up, we can't rule out a return to 112.70, and then ultimately looking at this triangular consolidation, double bottom leading towards a move towards 115.72 over the coming days and weeks. And perhaps it's a situation like in the US dollar next in April where we saw a return to fresh highs by mid-month, and then we shrunk and slumped to fresh lows by the end of the month. Euro dollar could initially rally up here as maybe some of the concerns about Greece pass. We see further short covering the euro, and then ultimately price returns lower over the rest of the month. Right now, time will tell, but indicators still in counter trend mode right now. And if we were to see the indicators move below their median lines and price break below 110.50, we'd have more security or feel a little bit safer in abiding by that seasonal forecast. Pound dollar is a bit more of a wreck. You have the elections coming up in 2 days. I said at the end of last week, say it again now, just stay away from the pound until these elections pass. It's just not worth it. You're getting a lot of whipsaw price action, fast movements, liquidation of positions, it looks like, based on the way some of these candles have formed. It doesn't look like something that you want to be involved with unless it's absolutely necessary. And of course, this is speculative trading, so it's not absolutely necessary. It's probably best to wait the next few days until the election results settle and we get a better picture for what the governance picture is going to be there like. And if it comes out where there's a split or hung parliament, probably means that we're going to see elections again later this year. And if that's going to be the case, you have to factor that into the BOE timing cycle, and probably means the BOE is going to be on hold for at least 2015 and probably at least the first half of 2016 as we engage the potential BOE following the Fed in terms of raising rates. Aussie dollar saw a nice rebound overnight after the RBA cut rates to the record low 2%. Of course, markets are forward looking, so when the RBA cuts rates and doesn't really give any solid indication that they're going to be doing so again in the immediate future, you take a lot of the speculative wind out of those sales, and ultimately means that investors need to cover positions. So right now, what's to say about the Aussie dollar market? We just saw a rebound back up to former channel support. May mean that ultimately we're due for this was the retest and we're due to trend lower again. Indicators are in bearish territory, but ultimately from a longer term perspective, this has just been a boring market. I know we've carved out seen both sides of our 450 pip range here, but this market's been range bound for the past 3 or 4 months, and I really don't like trading ranges. So until we get a concerted break, a weekly close through 80.30 or down through 75.25, it's probably best to play the range. We're kind of in the middle of it right now, so there's nothing really interesting to look at from that perspective. And lastly, dollar yen. Dollar yen, this has been our one thing that we've been watching for a break higher. We saw this triangle wedge start to break up back on the 30th, and our belief was that you have the lowest short positioning in the yen going back to the fourth quarter of 2012. And in light of the fact that the yen wasn't able to take advantage of the US dollar while it was weakening, the fact that the dollar stabilized, and we've seen that pretty much no one in the market is short the yen anymore, you have an opportunity for traders to come back in there and smack the yen lower once more. So if you're going to see rising interest rate differentials, dollar yen is the primary place to look. Look no further than dollar yen, and right now it seems that it's getting ready for its big break higher. If it's equity markets driving it, if it's US yields, dollar yen seems poised for its next move up. Of course, keep in mind, NFPs are Friday. If NFPs come in disappointing, dollar yen could be wrecked. So that would be the major, flying limit there for the greenback. All right, that's it for me today. I'll be back later on with another video. Keep in mind that I'll be on DoD, Daily Effects on Demand Room, Thursday and Friday, 8 to 10 Eastern, 12 to 14 GMT. Would love for you to join me there. You can always reach out to me through the Daily Effects Real-Time Newsfeed, Stock Twits, and Twitter. Before then, CVecchioFX, or email me, cvecchio@dailyeffects.com. If I don't speak to you before then, good luck trading the next few days.